Hello and welcome to Neuberger Berman's Private Markets Academy. I'm Jose Cosillo and I serve as a managing director and lead our intermediary teams in EMEA, Asia, and Latin America. We partner closely with our counterparts across regions. This module is focused on portfolio construction, which is a primary driver of investment success in private markets. Given recent trends, there are more investors than ever building private portfolios, making the need for education critical. The ongoing democratization of private equity continues to bring in waves of investors who are new to the asset class. In just the last 3 years, more than $4 trillion in new capital has flowed into the private markets from investors eager to capitalize on the return potential. Without the proper blueprint, however, many of these new investors will fall short of realizing the benefits private investing can offer. In this case, the blueprint is your plan for building and diversifying your client's asset allocation mix. And here's why it's so important. Asset allocation historically accounts for 91% of a portfolio's return. Portfolio construction strategy is paramount, and today we are going to share some insights on how you can begin the journey and gradually develop private equity portfolios that can help you and your clients achieve your goals. Our 3 objectives for this module are to educate you on the most important factors and considerations when building private equity portfolios. Then, to elevate your knowledge by exploring asset allocation tactics and how the right mix can be a highly effective complement to your existing investments. And last, to empower you, which we will do in part by sharing some of the more valuable lessons learned in working with both individual and institutional investors. Here's how the module will flow. Each chapter will run for approximately 10 minutes. In chapters 1 and 2, we will educate you. Chapter 1 focuses on several important considerations to keep in mind as you integrate private market exposure into diversified portfolios. And then in Chapter 2, we'll narrow the lens and explore strategies for allocating just within private markets. We will also delve into the importance of good manager selection. Chapter 3 is about elevating your knowledge, which we will do by comparing 2 popular private equity investment vehicles, traditional drawdown funds and evergreen funds. I mentioned the democratization of private equity earlier, much of which has been driven by the ease of access provided through evergreen vehicles. In Chapter 4, we'll empower you by sharing some real-life lessons learned that we know will resonate with you as you start on your journey. And lastly, we will address some of the common myths and misperceptions about building private market portfolios and have our team share their thoughts. To help us kick off, it is my pleasure to introduce Shannon Saccocia, Chief Investment Officer of Neuberger Berman's Private Wealth Business.
Hello, I'm Shannon Saccocia, Chief Investment Officer of Neuberger Berman Private Wealth, and today we're going to discuss some key considerations related to allocating to private markets within a broadly diversified portfolio. We think it's useful to set some groundwork for this conversation and to ask the question, what does that portfolio look like? This is often posed in terms of the traditional 60-40 allocation, which has long been the rule of thumb when building out a moderate allocation for an investor. 60% equities and 40% fixed income. That's what constitutes a diversified moderate risk portfolio. And this type of construct has been an underlying tenet of portfolio construction for many years for individual investors. However, over the last several years, there have been questions about the efficacy of a 60-40 portfolio. In fact, a sizable allocation to private markets has often been cited as part of the long-term success of major endowments and foundations. By having a broader investable universe and a longer time horizon, institutions up their odds of delivering on their desired outcomes. In looking more closely for a minute at how these larger pools of capital are allocated, in many cases they are more along the lines of equity and fixed income, both public and private, and then considering other exposures. So there's very little differentiation between public and private in terms of that high-level allocation. When people talk about the 60-40 being dead, this, in our view, is what they're really saying. that even modifying the 60/40 construct to include 10 or 15% in alternatives is too simple in some ways to explain the changes in the underlying universe of opportunities. Is private equity that different from public equity in terms of how success is derived? Is private credit different from public credit, aside from how those transactions are executed? The reason that a more simplified approach is potentially limiting is that the sheer number of available private market opportunities has expanded significantly over the last 30 years. The universe of public companies has changed dramatically. While there are over 18,000 private businesses in the U.S. with more than $100 million in annual revenue, there are now only 2,800 public companies. If you go back 30 or 40 years, some of the rapid growth that was experienced by investing in small and microcap companies, for instance, is not available in this current environment, as many of these companies have yet to go public at this stage. The other thing to think about is the ways in which you can invest in public companies are more limited, whereas private market solutions can be creative and can potentially support the growth of these businesses better, as they can be more customized in terms of what the companies actually need. When bifurcating your portfolio between private markets and public markets, it's important to remember that 1, public markets have changed meaningfully. 2, private markets translate to a wide range of solutions. And 3, construction of these portfolios will vary from investor to investor. In that way, thinking about public and private market exposures together is really about putting the assets where they belong from a structure perspective. It should really come down to what is the desired outcome of that portfolio. What is the liquidity requirement of that portfolio? And what is the benefit from a diversification standpoint of the private markets exposures that are being incorporated? In short, when putting together a portfolio construction that includes both public and private markets, our view is that taking a bucket approach is inappropriate. Instead, the inclusion of both public market and private market exposures is an expression of the exposure that one would like to gain across the investable universe. With that as a backdrop, investors often ask us, where do I start? And what's the best first step in allocating to private markets? First and foremost, we advise to start slow. So what does that mean? It's not just on the pace of investments, but more importantly, ensuring that investors have been educated in order to feel comfortable allocating to private markets. Admittedly, this can feel overwhelming at times, especially in a dynamic market environment where new strategies are being introduced that many investors may not have had exposure to. This education can cover a lot of different areas, but most importantly, investors should understand what their expectations should be from different private market opportunities. What are the barometers for success? How are the returns generated? How do managers differentiate in their approach? There's also a tendency to look at large pools of capital, such as pension plans or other institutional investors, as a benchmark for the manner and the size in which portfolios should be allocated to private markets. This is probably not the best approach. As we mentioned earlier, liquidity needs, time horizon, and tax treatment are all different between individuals and institutions, so pushing for a 25% allocation to private markets out of the gate may not even make sense for individual investors. Let's talk a bit about liquidity, as it is one major difference between public and private markets. While it is very easy to invest on a major equity exchange, be able to execute your transaction, and receive your proceeds in many cases the next day, the timing of liquidity for private markets investments is not guaranteed. It is very challenging for investors who have not yet invested in private markets to understand the necessity of this illiquidity, and yet it is an important factor in delivering success in private markets. From the advisor's perspective, when speaking with investors, it's important to understand that there's also a difference in the way that you message around private markets investments. Because there is a longer time horizon for investments to be monetized, it's important that on a regular basis, you're providing updates on the underlying strategies and their performance. The transparency that's available in the public markets is not available in the private markets. Therefore, those expectations of the frequency of data, how often you receive performance, and in general, the cadence of the information that the investor will receive should be set well ahead of time. It's critical to think about the behavior and the pattern of programmatic investing that's required to create success in private markets investing. Investment performance may vary from year to year, and that can be based in large part due to what is happening in the markets and the economy. This acknowledgement of the need to invest across vintage years, which are the years in which the majority of a fund's investments are made, should be part of the conversation around how to structure a private markets portfolio. By investing over multiple vintage years, there is a further level of diversification that goes beyond just having multiple portfolio investments. It's also important to understand the investor. There are investors for whom illiquidity feels very uncomfortable. There are also investors that may look at the available public equity options and see much lower fee profiles for many of those investments. Or they may be looking for investments that return a more frequent cash flow. Those conversations are necessary to understand whether the client should be put in a certain type of structure or a certain type of vehicle, or whether there's a particular asset class within private markets that's just not going to be suitable for them. Lastly, it's important to consider what the eventual goal of implementing private markets exposure in a portfolio is. For some investors, they may be looking to increase the income in their portfolio. For others, they may be looking at a private markets allocation to diversify the risk and reward characteristics of their overall portfolio. Either way, the selection of the underlying private markets exposure should be aligned with the desired outcome of the particular portfolio. In doing this, the investor will believe that a particular investment makes sense and is suitable for them, but that a programmatic approach and the consistency of that programmatic approach over several years will be more likely to be realized. With that as the foundation, a frequent starting point for investors within their private markets allocation is private equity. In most cases, investing in private equity funds gives investors the exposure to companies that are generating revenue, for as we discussed earlier, many of them are more mature in their life cycle. As a result, they are able to be valued in a similar way as public equity, and yet they don't have the handcuffs of filing and the transparency that are necessary to be listed in the public markets. That can lead over time potentially to other satellite exposures in more specialized areas like co-investments and secondaries, but really starting with that core portfolio and understanding the dynamics over time of how returns are generated, the liquidity, and then the timing of those liquidity events allows investors to get comfortable with the idea of private equity before they go into more niche part of the markets. It also creates better discipline for the investor. Rather than jump into a niche trend based on market exuberance and potentially a more binary outcome, a diversified core exposure may allow them to participate, but not necessarily be reliant on that theme succeeding to yield returns. With this foundation in place, and clients who have become more comfortable with private markets, then conversations can continue around diversifying and expanding into other areas of private markets. Whether that's real estate or private credit, private equity and the understanding of how private markets work can be the first step into building out a diversified private markets exposure over time, which again creates the opportunity to access a larger investable universe than what is currently available in public markets.
Picking up where Shannon left off, Many of the same formulas apply when you're building a private equity allocation. Investor preferences around liquidity, cash flow generation, and the overall risk-reward profile serve as major anchor points on this blueprint. In other words, the answers to the questions like how long are you willing to wait for capital to be returned and how much risk can you take on will go a long way in helping to develop the right portfolio mix. When investing in private equity, the menu of strategies can feel infinite. In this chapter, we'll educate you on the complementary roles that different strategies play in a portfolio, methods for diversification, and we'll cover the importance of manager selection. I am pleased to introduce Matt Weiner, a managing director on the Neuberger Berman private equity investment team, who will share some insights and allocation strategies.
Hi, my name is Matt Weiner, and I'm a managing director on the private equity investment team at Neuberger Berman, based in New York. This module will focus on how to effectively allocate investments within the private equity asset class, considering the risks and rewards across strategies, asset classes, geographies, as well as other factors. I'll be going over some general concepts, but there are several important questions to keep in mind as we go through this module. How will private equity complement existing assets, including public investments and, to the extent applicable, other private investments? What are the expectations for the role private equity holdings will play in a diversified portfolio? How long can you wait for capital to be returned? What is the level of risk you are willing to take on? These are the foundational questions that will help guide you in deciding how to allocate within private equity. But first, let's discuss some general considerations to help guide you in your decision making. When investing across private equity, you should consider strategy, asset class, geography, and a myriad of other factors such as diversification across vintage year, manager, and industry. This leads to an abundance of different strategies and solutions that can feel limitless, but let's touch briefly on some of these key pieces and how they interact with one another. Let's start with strategy. When investing in private equity, there are three main ways to access the asset class. Through primary investments, which involve committing capital to new private equity funds, co-investments, where an investor invests directly into a company alongside another private equity firm, and through the secondary market, in which investors purchase existing stakes in private equity assets from other investors or the private equity firm itself. Another investment characteristic to consider when allocating to private equity is the specific asset class. Private equity is unique in that it allows investors to invest in companies at varying stages of their life cycles, from early development to growth to maturity. Going from the beginning of the life cycle to the end, the asset classes within private equity include venture capital, growth equity, buyout, and special situations. Venture capital invests into private companies at the very beginning of their lives and includes mostly startups and emerging companies. Rewards include high upside potential, as successful ventures can yield significant returns. There's also what we like to call innovation exposure in venture capital that gives you access to cutting-edge technologies and disruptive business models. However, venture also comes with high failure rates. Many startups don't make it, which can lead to capital loss. Growth equity typically consists of investing into companies that are still young but have started to generate revenue. These companies are generally a bit more mature and are seeking capital for expansion, offering moderate risk with substantial growth potential. There's execution risk with growth equity. Companies are often in the expansion phases and require effective scaling strategies, but they can also deliver strong rewards if they are successful. Because of their greater risk, we generally suggest lower allocations to venture capital and growth equity. Buyouts are generally investments into companies that are more mature with established, stable cash flows. These companies come in various sizes and, like public equities, can be classified into small cap, mid cap, and large cap categories. Buyouts have the potential to provide consistently strong returns through operational improvements and strategic exits. From a risk perspective, buyouts often include leverage, which can create a higher level of financial risk and market dependency on interest rates and credit availability. Used prudently, financial leverage can help amplify the returns of a buyout investment. Finally, special situation investments are unique opportunities that often come at the latter stages of a company's life. From a reward perspective, there is the potential for high returns through strategic restructuring or market recovery of underperforming assets. Because each opportunity is unique, special situations can provide diversified exposure to non-traditional opportunities that may not correlate with broader market trends. However, from a risk perspective, these investments are complex, as distressed and turnaround scenarios often require specialized expertise and knowledge of a company's capital structure. Knowing the right operational and financial levers to pull to improve the operations of an underperforming business is critical to the success of a special situations investment. These investments tend to have more volatility than traditional buyouts, which can lead to uncertain outcomes depending on the successful restructuring of a company or market shifts. So how do these asset classes interact and what roles do they play in the portfolio? Venture capital comes with the potential for high reward but also high risk. Many investors use venture capital to add growth potential to their portfolios and to gain exposure to early-stage companies. But one thing to remember is that they can also have longer holding periods, which can result in longer performance lags due to the J-curve effect, as well as delayed distribution of invested capital. Growth equity provides a balance between high-risk venture capital and more stable buyout investments. Investors will generally diversify venture and growth equity investments, with more stable investments typically found within the buyout asset class. Buyouts provide a core, stable foundation due to relatively predictable performance and generally tend to be the largest allocations within private equity portfolios. Within buyout, it is also important to distinguish between company size. For instance, the small and mid-cap buyout spaces have the greatest number of opportunities and provide access to different methods of value creation. Large-cap companies are a great complement to small and mid-cap and tend to have more stable cash flows, but it is also harder to generate outsized returns due to the scale of the companies. Finally, special situations are more opportunistic investments within a portfolio that aim to capitalize on market dislocations and can enhance diversification by providing exposure to upside opportunities during times of economic volatility. In general, we often see private equity investors have the largest allocations to buyout, using venture, growth equity, and special situations as more opportunistic allocations, depending on the risk tolerance. Now, let's shift to geography. North America represents the most mature market for private equity and is one of the most active markets, and tends to be the largest regional allocation for many private equity investors. As a core market for private equity, the U.S. in particular is characterized by a large and generally stable economy, a high number of fund managers, a robust company opportunity set, highly experienced management teams, deep financing markets, and relatively accessible IPO and M&A exit markets, which are all key benefits to private equity. While it's a mature market with stable returns, there's also a high level of competition. Europe, on the other hand, is unique in that its opportunity set is very diverse, with many political and economic variations. Some investors will opt to invest in pan-European funds, which allocate across the continent, while others will take a more country-by-country approach. Overall, the region has a well-developed and sophisticated private equity ecosystem with a large number of high-quality managers, companies, and management teams, but it's a smaller and more fragmented market than the U.S. Asia is an area showing rapid growth potential, but with caution flags in the form of regulatory and market risks. And finally, emerging markets also have high growth prospects, but come with elevated geopolitical and macroeconomic risk. Both Asia and the rest of the world represent a highly diverse group of markets, each with a different balance of economic, political, currency, and other market risks. While there are numerous good managers and opportunities, investors generally will include them more opportunistically. I've shared a lot of information with you and would like to mention other considerations when investing in the asset class. The private equity strategy, the asset class, and the associated geography tend to be the dominant factors investors consider when determining allocations within private equity. But there are a myriad of other characteristics that can come into play as well, such as vintage year, manager selection, and industry. Vintage year, or the year in which the investment takes place, is important for diversification. No one can predict the market, so having a steady deployment across a wide range of years is very important. Keep in mind, different managers have different skill sets. You want to ensure you're allocating to a diversified set of managers from generalist to sector specialist across asset class, geography, and industry. Lastly, investors will also seek to be diversified across a variety of industries, although some may overweight or underweight depending on their market views. One common theme across all these factors to consider is the importance of doing your due diligence. Private equity is a long-term allocation, so making sure you and your clients are partnering with the right manager is critically important, particularly as performance dispersion between managers is significant. But with careful diligence, we believe by strategically allocating across these various investment characteristics, investors can build a balanced private equity portfolio that optimizes risk-reward dynamics and adapts to various market conditions. Before we end the session, I want to highlight 3 key takeaways. First, when investing in private equity, consider how you are accessing the asset class, whether it's through a fund investment like a primary or secondary, or directly like a co-investment. We believe that each have their unique benefits and can be additive to an overall private equity portfolio. Second is to ensure that you are appropriately diversifying across strategy, vintage year, manager, and industry based on your specific investment needs and objectives. Investing into private equity means you need to be diversified within the asset class, just like you would have different holdings in an equity or fixed income portfolio. And taking into account your risk-return profile will help you determine what areas to overweight or underweight. Finally, conducting thorough diligence is important. This is a long-term asset class, so making sure you do your homework on not only what meets your private equity investment objectives, but also what PE firm to partner with is crucial. We hope that you found this session useful, and if you have any questions, please do not hesitate to reach out to us.
So, we have now discussed what investors should consider as they integrate private market investments into broad portfolios, and have narrowed that down to give you some strategies for building just your private equity blueprint. Let's now go a step deeper and compare 2 of the more common vehicles investors use to access private equity: traditional drawdown funds and evergreen funds. Once again, it comes down to investor preferences. There are significant differences between the 2 vehicles, from structure to term to liquidity to investment minimums, all of which need to be factored into your decision to choose either a drawdown or evergreen fund. For this chapter, I'm pleased to introduce José Luis González Pastor, a managing director on Neuberger Berman's London-based private equity investment team.
Hi, my name is José Luis González, and I'm a managing director on the private equity investment team at Neuberger Berman, based in Europe. During our time together, I will discuss the type of investment structures available to you when investing in private equity, as well as what you and your clients need to consider when selecting a structure. Please keep in mind that each investor is different. The structure you choose will depend on you or your client's individual situation, investment objectives and restrictions, and a myriad of other factors that we won't be able to cover in full here. However, we hope that this session will give you some general guidelines to work with to find the right solutions for you and your clients. With that, let's dive in. Private equity initially was limited to one dominant structure, what many refers to as the traditional private equity fund. This structure is generally set up as a limited partnership. Here, a fund is created that is managed by the private equity firm, and investors allocate into the fund, which then makes investments on their behalf. Private equity funds have very structured timelines. They raise investors' capital for a certain amount of time, and once they hit their target size, the fund closes and is no longer open for investments. Investors commit a certain amount of capital over what is known as the fund's investment period, which typically runs for 3 to 5 years. As investments are made, the fund will call capital from investors, and as distributions are earned, will pay it back to investors. The private equity firm is then expected to realize or exit all underlying investments and pay back investors their initial commitment, plus returns after the fund's term, which can range from 8 to 14 years. There is also no liquidity over the life of the private equity fund. To obtain liquidity, the investor would have to sell existing positions on the secondary market. These funds are also typically have minimum investment requirements and eligibility restrictions. Due to this, their investor base has historically consisted of institutional investors or ultra-high net worth investors. Valuations are usually made and reported quarterly. Another structure for accessing private equity is an evergreen fund, An evergreen fund is a perpetually offered investment vehicle that is fully funded at the outset and does not require subsequent capital calls. In the event of a private equity portfolio company exit, the proceeds are reinvested instead of being distributed back to investors. Evergreen funds can be closed or open-ended, have no fixed termination dates, and allow for periodic redemptions and subscriptions. Recent developments in evergreen funds have broadened access to private market investments, offering several structural options to investors. For example, an evergreen fund can be an exchange-listed closed-end fund structured as an investment trust. Because these vehicles have shares listed on an exchange, investors' capital is immediately and fully deployed into an existing portfolio, and shares can be sold to obtain liquidity. While shares can be purchased and sold on a daily basis, the net asset value or underlying value of the assets is typically performed and reported monthly. Another type of evergreen vehicle is one that is open-ended and not listed on any exchange. Here, the type of structure can depend on the investment's domicile and can be very different in the US, which has a straightforward frameworks, than in Europe, where investors have more type of investment structure to choose from. Evergreen vehicles deploy total committed capital on day one into an existing portfolio. However, unlike the exchange-listed closed-end funds, evergreen funds offer the potential for liquidity on a periodic basis, typically monthly or quarterly, and can be subject to restrictions. Evergreen private equity funds can be appealing options for both individual accredited investors who are attracted to this ease of use and simplified structure, and larger institutional investors. For these fund types, reporting tends to be monthly. That was a quick overview of the types of investment vehicles you and your clients can choose. Let's now explore the benefits of investing in a traditional private equity fund structure. First, pure private equity returns. Because there are no allocations to liquid investments to meet redemption requests, the returns investors achieve come fully from private equity investments and are not diluted by more liquid investments. Second, greater flexibility in types of private equity investments. Given the longer timeline of these investments, traditional private equity structures can make larger allocations to long-term investments, such as other funds investments or longer duration direct investments. Conversely, evergreen structures, which need to provide periodic liquidity, may be more inclined to make investments that are shorter in duration. Third, potential for lower fees. Because commitments tend to be larger in traditional private equity vehicles, there may be lower management fees and carried interest. Next, potential to have priority in investments. In some cases, a private equity firm may prioritize traditional funds when it comes to allocation of investments over evergreen funds that may have smaller-sized investors. Lastly, timing of investment is less important. Investors in traditional private equity funds are generally on equal footing in that they are considered to have entered the fund at the same time. They receive access to the same investment opportunities, and any portfolio gains are shared equitably. As a result, the point at which you invest into a fund does not carry as much weight as when you invest into an evergreen structure, which can have a noticeable impact on returns. Now, from a different vantage point, let's cover the key benefits of investing in an evergreen structure. First, immediate and flexible capital deployment. Evergreen funds deploy capital immediately, offering investors the flexibility to gain exposure and reallocate at their discretion, thereby putting liquidity decisions in the hands of the investor. Second, continuous compounding of returns. After the ramp-up period, evergreen funds provide access to a fully invested, transparent portfolio with continuous reinvestment of realizations into new investment opportunities, which allows for compounding returns. This enables investors to maintain consistent allocations more easily with indefinite exposure. Third, ease of use for investors. Evergreen funds offer more simplified structures with fewer operational burdens than traditional private equity funds, which often can result in investing adopting an overcommitment plan across multiple closed-ended funds to reach their desired level of exposure. Commitment plans and external cash management programs to fund future capital calls are unnecessary with evergreen funds, as these processes are internalized within the fund. Periodic rebalancing by the investor through tenders or redemption features reduces the risk of being over or underweight target allocations. Administrative burdens and pain points associated can be minimized by eliminating re-ups, reinvestment risk, and re-evaluation processes that are required with investments in new fund structures every few years. Lastly, the potential for periodic liquidity. While private market investments are illiquid, evergreen funds are semi-liquid and allow for subscriptions or redemptions, often on a monthly or quarterly basis. Now, let's discuss how you and your clients can decide which investment vehicle is most appropriate. A key innovation in the democratization of private equity has been the development of evergreen funds, specifically open-ended funds. Open-ended private equity funds can mitigate certain challenges associated with traditionally drawdown funds, which require investors to make commitments upfront and then call their capital over time as they identify investments and distribute proceeds back as sales are executed. Open-ended funds allow the investor to buy into a diversified pool of assets at fair market value. These funds offer increased flexibility by allowing investors to make additional investments or to withdraw from their fund at irregular intervals, subject to available liquidity. Open-ended funds typically reinvest any realizations from existing investments into new investments, creating a perpetual investment cycle that allows an investor to maintain exposure over time without the need for capital calls and distributions or the need to make new commitments. Together, these features can create a more adaptable and operational simple approach to private equity investment. Evergreen vehicles are also generally preferred by individual investors due to their lower eligibility requirements and minimums. However, there is a commonly held misconception that open-ended vehicles are solely for individual investors, and that institutional investors will continue to use strictly traditionally drawdown funds. We have found the opposite to be true. However, as we continue to see increased adoption of open-ended funds by institutional investors. Institutions may leverage open-ended funds because they can allow for more precise portfolio management. Historically, institutions have built their private equity portfolios with traditional fund investments by pursuing overcommitment strategies, which can help minimize the impact of uncalled capital and keep investors constantly invested at target level allocations. This can be complex, with liquidity management and reinvestment decisions falling on the institutional investor. Open-ended funds ease these challenges by transferring responsibilities to the manager. Also, traditional fund investors are limited by the timing constraints imposed by the fundraising and investment cycle of drawdown funds, where private equity managers bring new funds to market every 3 to 5 years. Investors who want to maintain vintage diversification for a given strategy must make serial commitments, even if they are tight on liquidity when a fund comes to market. Open-ended funds ease this burden since they have inherent vintage diversification, and they allow the investor to trim or add to their positions when needed. We believe that traditional drawdown funds will continue to play a key role in the construction of the private equity portfolios for many institutional investors. But open-ended funds will increasingly be viewed as a complementary tool that can aid in portfolio construction and expand access to the asset class. That said, these are numerous other factors you and your clients need to consider when identifying the optimal structure. This can include, but are not limited to, taxation, jurisdiction issues and varying restrictions, the investment's timeline, familiarity with investment structures, and private equity firm relationships. To complicate things further, there are also investment structures that may fall in between a traditional and evergreen structure. For example, a traditional fund may have a shorter duration or mechanism in place to make it more operationally simple. As I said up front, it is essential to understand your specific investment objectives and restrictions to decide which structure is most optimal for you and your clients. For all types of investment structures, it is imperative to conduct thorough due diligence to ensure that who you work with has the necessary expertise, resources, and skill set to properly implement, manage, and monitor the investment structure you select. New evergreen fund investors, for example, will want to make it a priority to understand the unique skill sets required to efficiently manage the strategy through this fund structure. Investors need to consider the investment acumen of the manager, as well as whether they have the skill sets in place to manage an open-ended fund. First and foremost, we believe that managers should offer the same institutional quality investment opportunities in their open-ended funds that they provide through their traditional drawdown funds or custom mandates for a given strategy. Secondly, managers need access to a large enough opportunity set of investments to allow the open-ended fund to maintain its target deployment level. To state the obvious, the fund must stay invested in private equity to generate private equity returns over time. This makes robust deal flow critical to proper fund management. Open-ended funds must manage regular inflows and outflows and be prepared to deploy capital when it comes in, whether through inflows or realizations. Lastly, management of an open-ended private equity fund is more operationally complex and requires a broader range of skills than management of a traditional drawdown fund. As the manager is responsible for reinvesting decisions and liquidity management, a manager should have experience in managing liquid assets as well as private assets. Evergreen or open-ended funds have gotten a lot of attention recently, as they are an important development that has widened the aperture of eligible investors and solved certain needs, but they are not a one-size-fits-all solution. No one structure is inherently better or worse than the other. They all simply represent various tools in the toolbox. We think it's important to provide investors with the optionality to access private equity through a range of investment structures. Ultimately, the goal is to determine how one can access private equity in the way that best meets their needs and objectives. We have covered a lot of ground here, so let's close with a few high-level takeaways. First, there are now numerous structural options for investors to choose from when investing in private equity. These include the more traditional private equity structures with set, long-term timelines, which are illiquid, and evergreen structures which can be operationally easier, have potential liquidity opportunities, and can be more accessible. Second, the structure you choose is highly dependent on yours and your client's investment objectives and timeline. Traditional private equity and evergreen funds are not necessarily mutually exclusive. They can complement one another within a portfolio, serve as a core private equity allocation, or complement an existing portfolio. And last, as with all investment structures, it is crucial to ensure that the private equity manager you select to work with has the right skills, resources, and expertise to properly implement the structure and meet you and your client's private equity investment objectives. There are numerous details and nuances that we didn't have time to cover here, so if you have any further questions or want more specific guidance on how to select the right private equity structure for you, please do not hesitate to reach out to us.
Hopefully, you now know more about the key differences between drawdown funds and evergreen funds, both of which have their distinct purposes, but which can also complement each other within a portfolio. For Chapter 4, we are excited to turn to two of our colleagues who work with private wealth and institutional clients every day to strategize on how best to build diversified private market portfolios. Shannon Sikocia, Chief Investment Officer of Neuberger Berman Private Wealth, will share some valuable lessons learned in working with high net worth investors to gain more exposure to private markets. And Anu Rajakumar, a managing director on the multi-asset investment team, will share insights into some common challenges institutional investors have encountered during the portfolio construction process and how they have tackled them.
How do we put this in practice? An example we often see is a next-generation investor who is gifted a meaningful amount of assets from their parents or grandparents, and this wealth has been created through a liquidity event, often through the sale of a business. After years of generating wealth primarily through an incredibly illiquid source, the parents or grandparents had always been very heavily exposed to cash and other very liquid investments to balance the illiquidity of that business. As such, there haven't been very many, if any, investments in private markets. However, with the next generation investor now looking at a very different time horizon, and also not saddled with that risk of illiquidity that their parent or grandparent faced, it widens the aperture and the appetite for private markets investments. The challenge, of course, is that 1, they are unlikely to have seen those types of investments and exposures in the parent or grandparent portfolios historically. 2, there was likely, either from the advisor perspective or from the parent or grandparent themselves, the view passed down that the illiquidity created some additional risk, and therefore the next-gen investor would be better off continuing in public markets. The way we have mitigated some of these concerns is to outline, first and foremost, the longer time horizon of the next-generation investor. We have also taken the approach of walking through the difference between the illiquidity of a single business versus the illiquidity that's required in managing a diversified pool of private market exposures. Investors should be encouraged to relate their own experiences and biases in these discussions. The best way to overcome objections is to discuss them openly and with candor. The 3 main objections tend to be liquidity, fees, and transparency, and private markets investors at any level will want to gain some comfort that these trade-offs are worth it. Once we've created a good foundation of knowledge, building out that core piece, that core allocation, if you will, to private equity affords the next-gen investor the initial experience of understanding the benefits of private equity. However, they're also able to, in many cases, understand that the value that was generated from that family business is not inconsistent or all that different from the value that's going to be generated from this diversified pool of portfolio companies. After building out a core exposure to private equity, we continue to educate, discussing the benefit of investing over multiple vintage years. We also consider investing in more specific areas like co-investments or secondary strategies, focused specifically on an industry such as real estate. At this point, we expand the conversation to private credit, which can provide desired income, or even to private markets exposures outside of the fixed income and equity asset classes. Aligning the portfolio with the investor's long-term goal is the most important piece, and as a result, the combination of strategies can vary, particularly over time as needs change. Most importantly, the education around why private markets and why private markets within the context of the diversified portfolio is critical in helping the next generation investor to understand that the opportunities that are afforded in private markets, just as they had been with their family business, can help to potentially create longer-term wealth creation and growth for their children and grandchildren.
Hello, I'm Anu Rajakumar, a Managing Director on Neuberger Berman's multi-asset team, which constructs and manages customized portfolios for institutional investors around the world, including pension plans, endowments, foundations, and sovereign wealth funds, oftentimes which includes incorporating private equity into multi-asset portfolio construction. As we thought about how to best make these experiences with institutional investors most valuable for you and your clients, we landed on discussing 3 challenges that we see when allocating to private equity for institutional investors, revolving around the 3 Ds: denominator effect, distributions, and dispersions in manager performance. First, the denominator effect. This occurs when a significant decline in one portion of a multi-asset portfolio, often public market investments, leads to an overall reduction in the portfolio's total value. Essentially, in a major public market decline, the value of the public holdings will decline, while the private equity may be relatively sheltered due to less frequent pricing, leading to a higher percentage allocation to private equity, creating an unintended over-allocation. For institutional investors, this phenomenon can disrupt and potentially brief carefully crafted strategic asset allocation guidelines intended for investor and beneficiary protection. Now, market conditions such as stock market declines and rising interest rates can exacerbate this issue, as private market valuations typically lag behind more frequently valued public market investments. To navigate the denominator effect, institutional investors have several options. They might choose to wait for market conditions to stabilize, they might widen their target allocation thresholds, or they might pull back on forward commitments. In some instances, they may be forced to rebalance, in which case investors may have to sell their private market stakes on the secondary market, sometimes at heavily discounted prices. Let's talk about 2022 as a prime case in point. We had several clients who had heavily allocated to private equity in 2020 and 2021, meaning that they had committed at a faster than average pace in investing their private equity portfolios. Now, if there was ever a year where everything that could possibly go wrong in markets did, it was 2022, when just about every asset class suffered negative performance. This collective drag caused the denominator effect to kick in for a number of institutional clients, some of whom were forced to sell private equity holdings at a discount on the secondary market to be able to meet their obligations. In these circumstances, advisors and their clients must assess their unique situations, remain committed to their long-term goals, and if they're able to, consider opportunistic investments, especially in an environment that offers both challenges and potential opportunities. Whether it's an institutional investor seeking to meet those obligations or an individual investor requiring cash flows, the fact that the unexpected can happen at any given moment needs to be factored in. At a high level, we encourage investors to think of their public and their private investment holdings more holistically, rather than as separate silos. It's not always about chasing the shiny object for the best performance, in this case, potentially private equity. Yes, it can be high performing, but this needs to be balanced by the inherent illiquidity risk. As with any long-term investment, but especially with private equity, it is a marathon, or at least a half marathon, and definitely not a sprint. Take your time and build smartly, so that if or when the denominator effect comes into play, you and your clients will be very happy with the pace and the approach you took, and it'll show in the bottom line. The second D is distributions. Specifically, what can investors do to better protect themselves in environments where private equity distributions are declining significantly? The goal is to avoid a liquidity crunch at all costs, and one way to provide a shield is by fully understanding the interplay of the different types of asset classes in a portfolio and what that means for overall performance output. In working with clients on the institutional side, we really want to understand correlations and volatility patterns and are constantly conducting return and volatility assumption tests to help them build more risk-dispersed portfolios. This type of analysis is even more important now, as distributions have been falling short of expectations, underscoring the risks involved and how quickly circumstances can change. For some investors, the rug has been pulled out from under their feet, and they're having to find new means of income, or they have to rebalance. When we incorporate private markets into multi-asset portfolios, we seek to diversify across asset classes, across vintage years, and across geographies to help alleviate some of the stress that may arise if distributions slow down. The third challenge that private equity investors may face is dispersion of manager performance, which refers to the significant variation in returns amongst private equity managers. Unlike in public markets, where performance tends to cluster within a tighter range, the difference between top quartile and bottom quartile private equity managers can be substantial, sometimes upwards of 15 percentage points. This wide range highlights the inefficiencies within private markets and the critical role that manager skill plays in generating returns. As a result, selecting a top-tier manager is crucial for maximizing the return potential of private equity investments. However, it's also essential to recognize that private equity is a long-term investment, and short-term underperformance does not necessarily indicate a bad manager. Private equity funds typically have investment cycles that can last years, and market timing plays a less significant role in ultimate outcomes. Therefore, reacting to quarterly or even annual fluctuations can be counterproductive. Instead, investors should focus on consistent strategy execution, track record, and alignment of interests when evaluating managers. success in private equity often depends on patience, access to quality managers, and understanding the long-term nature of the asset class. To bring this concept to life, we've worked with clients holding legacy private equity portfolios which have demonstrated long-term underperformance due to poorly performing managers. In extreme cases, we've recommended a secondary sale for some of the private equity investments, which would allow us to build up the allocations again by investing in higher performing, higher conviction managers. These can be difficult conversations due to a short-term performance hit, but ultimately the clients have to be comfortable with this decision before proceeding. So to bring it all together, private equity is an important component of multi-asset portfolios for institutional investors for all the reasons you've been learning about: higher returns, diversification, access to unique opportunities, and more. But with that said, it isn't all rosy. We've discussed 3 key challenges to be cognizant of: the denominator effect, distributions, and dispersion. Understanding that these issues exist can put you and your clients in a better position to maximizing your private equity investments and overall multi-asset portfolios.
Let's now bring our speakers back to address some of the myths and misperceptions about private market portfolio construction. Myth 1: investing in private equity will add risk to my overall portfolio.
While there is admittedly less liquidity and often higher fees associated with these strategies, private equity has been shown over time to potentially enhance returns and reduce risk. This is due to the deep access to information that private equity managers have, the optionality that they have as it relates to the timing of transactions, and the distinct differences between the types of companies available for investment in the public markets versus the private markets.
Myth number 2: all private equity funds are the same and may yield similar returns.
For optimal diversification, investors should consider a mix of primary investments, secondaries, and co-investments, as they each play distinctly important roles in a well-diversified private equity portfolio.
Myth 3: the account opening process of private equity investments is too much work.
With the addition of evergreen funds, the eligibility and suitability requirements are less burdensome in comparison to traditional private equity funds. This structure could be a more appropriate solution to accessing the private markets for many of your clients. We encourage advisors to start the process by becoming private markets investors themselves, to gain familiarity with the account opening process so they understand the client experience and can accurately relate this to their clients. For European fund investors, you and your clients can access these solutions through portals such as Allfunds and Clearstream.
As we conclude this module on private markets portfolio construction, we hope we have educated, elevated, and empowered you to better understand the different ways to integrate private investments into your clients' portfolios and which strategies might be the best fit. At Neuberger Berman, we are committed to providing you with the knowledge and tools necessary to help your clients achieve their financial goals. Should you have any further questions or need additional information, please do not hesitate to reach out. We are here to support you every step of the way. Thank you again for your interest. We hope you can join us for future modules.